Well, thanks for coming on the podcast, Keith. This is Keith Wasserman of Gelt Inc. I'm very happy to have him and very excited. Do you want to tell us a little bit about what you do and how you do it?
Yeah, for sure. Well, awesome meeting you finally in person now. COVID sort of delayed this, but essentially I'm the founder and president of Gelt Inc. Gelt is an apartment investment and development company. I started Gelt with my cousin, actually, so it's a family-run business, but I started with my cousin in December of 2008, and we started buying our first building, which was in Bakersfield, California, in the heart of the Central Valley, around 2 hours north of LA. We started with literally one, fourplex. It was bank-owned, boarded-up kind of building, and we got an FHA loan. It was actually Damien, my cousin, that bought the first building with an FHA loan. He only had to put 2.5% down, which he didn't even have, so he had to borrow that from a friend.
Wow.
And then he got a cash advance of $10,000 on his credit card to do the rehab for the property, and that's sort of what put us into business. What was it, 12 plus years ago now? Yeah.
That's great to hear. One of my questions that I was thinking about asking you, you've always had an entrepreneurial drive. You had your eBay stores before when you were in college. You have property management software company, I think. You have your venture capitalist company. What motivates you to, how do you get the energy? What drives you?
Yeah, that's a great question. I think building something, creating, achieving. I'm an impatient person, but looking back, it's like, wow, we've accomplished a lot over the last 12 years. So, being impatient is cool, like day by day, but having a long-term vision and consistently working towards something every single day, making small progress every single day, will compound over time and make big things happen. So I think internally, I've, always, I grew up in a pretty well-off household, but I wasn't really given anything ever. I started my first business. I was like 15 years old. I would borrow money from my dad, but I would always keep a detailed notebook and pay him back as soon as I, sold the merchandise, and I kept using him sort of as a bank. So, it was great to have, parents that were supportive and, enable me to launch different ventures and, financially support those, but I would always pay them back and, with interest. And it was I don't know. I think it's intrinsic. It's a little family. We always talked about business and building wealth over time and investing. And, I was investing my bar mitzvah money at 13 years old. Wow. And I just like just the concept of entrepreneurship, starting stuff, investing in stuff, and seeing it being built over, a long period of time.
No, that's interesting. Yeah, the journey, I think, and the adventure and the challenges and the creating growth. You said long term. When you buy something like an apartment building, do you see yourself buying a long-term holder, or I don't know how long you?
Yeah, we typically sort of project 10-year kind of horizon, but the idea is we do that because we want to show the investors that real estate is long-term. Think long-term. This is an illiquid kind of investment, which I think is actually good. It forces you to hold long-term. That being said, we've sold deals after 1, 2, 3, 4, 5 years, but we're always looking to 1031 exchange. We always roll, via the 1031. We take advantage of that. And, if you do a chart and you show, you sell the building and then you pay your long-term capital gain and recapture, you have after-tax dollars. If you invest that over a long period of time versus having to just not have to pay those taxes and just keep rolling it, you're going to see huge divergence over a long period of time. So we feel like it's always best to exchange if we do sell. That being said, if something's doing great and throwing off cash flow and improving, and the area is improving, and the building is in good shape, and might as well keep it and not kill the golden goose laying the golden eggs, and just keep refinancing it over years and keep pulling out cash that way, and just eventually have all your money out and keep holding the asset in perpetuity. Yeah,
you said something at some point that real estate, that time and inflation were real estate's best friend. I thought that was something well put. I mean, why did you say that? What's that mean?
Yeah, so one of my mentors, who's since passed, his name was Jonah Goldrich. He always said time and inflation were real estate's best friends, and it's sort of like having a long-term horizon, and over time, with inflation, the value to reproduce the property, it keeps increasing, and even now you have construction materials rising, and you'll have labor costs rising. It just it's a great hedge against inflation having real assets like real estate in the portfolio. So I think as long as you're able to withstand any kind of shocks, there's always recessionary time periods. You always come through better on the other side as long as you could withstand them, not be a forced seller kind of thing. And then time and inflation will take care of the rest.
Yeah, I saw that what I like about apartment buildings, and that's sort of your focus, is that it sort of adjusts every year, and it keeps with the market. So if the market goes up a little bit, with commercial, like we were talking about that other property, the Air One, or commercial generally has longer term fixed lease rates, so it's hard to adjust to market if there is a downside or an upside.
Yeah, I think it's better for the tenant to lock in a long-term lease, but for the landlord, you want to sort of have those. I like annual. Yeah, you could definitely move and be at the market. It works both ways, though. If the market goes down, but at the same time, if the market's going down, the tenant's going to usually want reductions, and their businesses aren't performing as well. And if you want to, keep the tenant, if it's not the strongest of tenant with high credit and whatever, you got to work with your tenants also in general in retail, office, whatever. So I think I like real estate that has a lot of tenants. You don't have to rely on any tenant, to hurt the rent roll, like an office or shopping center, having hundreds of units in a building, and you're always gonna have people coming in, moving out, and it's okay. You'll have consistently pretty high occupancy, and if the unit sits too long, just lower the rent a little. Someone will come in.
Right.
That's the way. It's more consistent, the cash flows.
Right.
It's not as when the times are good, it's really good for commercial, but it's lumpy, the cash flow, and you have big capital expenditures whenever a tenant leaves, and
and it could be a long
fees
time.
And vacancy. Yeah.
So you said, I wanted to ask you, I didn't send this in the questions that I sent Natasha, your mentor. I wanted to ask you about them. What did they how did they really help you out? What did they?
Yeah, I've had a bunch of mentors. I mean, my first mentor is my father, essentially. So without him, we wouldn't have been able to grow so fast, right? He helped us. His firm did all of our legal work for us. He helped us with all the major big decisions. He helped us qualify for larger loans. He helped us bring in a lot of the original investors that were long-term clients of his or family friends. So he was the first mentor. Second mentor was another gentleman named Adrian Goldstein, who was with us 5 or 6 years, and then partnered with another gentleman to start another firm. But he was buying and managing apartment buildings with his father-in-law and had the experience, whereas we really didn't have the experience. So he was with us in the beginning and really helped guide us through the whole process of acquiring the deal, doing all the due diligence, improving the property, financing, the whole thing. He walked us through that, and we learned a lot from him. And then the other mentors along the way have been the likes of Jonah Goldrich, who I mentioned, the time and inflation guy, also taught us. He had another saying. It's better to. He'd rather regret not buying a property than buying a property that he would later on regret. So I thought that was a really poignant piece. And then Sam Freshman is another friend and mentor who's helped us tremendously. I met him probably in the beginning of the career, and his book, Principles of Real Estate Syndication, were one of the first books I had ever read in real estate. Highly recommend that. But yeah, Sam's been great over the years. He's helped us. If we were short on capital closing a deal, he would give us bridge financing. Usually someone would want a first trust deed kind of thing. He would do it, basically on a handshake and help us close the deal, and then we would keep raising money and then paying him back with a fair rate of return. But he's helped us multiple times with that, and signing on some loans that we thought maybe we couldn't qualify for, some of the larger loans. So and now Sam's like, he thinks he learns more from us than we learn from him, which I'm like, no, you got 60 years of experience. We're 10 years in or whatever. So I enjoy learning from the old timers that have been through a lot of cycles and seen it all, but they enjoy us because we bring a lot of youth and energy and new ideas. They're sort of stuck in their ways sometimes, so we help them see things maybe a little differently. But those have been the biggest mentors over the years for me.
No, that's incredible. I think that, yeah, the combination, I think, is fantastic when you have the wisdom and you have the sort of a different perspective. I think it's always enlightening.
Yeah.
When
sure.
you say you have investors, how is that different than like if it was your own capital?
Yeah, I'd say the biggest.
Because that's a whole business in itself. I mean,
Yeah, I think with investors we take less risk. If it was my own capital, I'd be more aggressive and not as worried about going down or lose. But like with our investors, our principle is like we never want to lose any investor principle. We haven't. And I'd say we are just very conservative in everything we do. We usually buy buildings with long-term fixed rate loans. We generally take low leverage. We always raise extra capital up front for reserves, so we don't have to ever go and do a capital call when times get tough, which they did during COVID in the beginning. We had some troubles with some properties with collections and stuff, and we had a few properties. We had never had a negative quarter until COVID hit, and on 2 or 3 properties we had where the expenses outweighed the revenue, and we had to just dip into the reserves, which was fine. We didn't have to do any capital calls because we had plentiful reserves. So I'd say with investors being ultra conservative, because we're trying to preserve our investors' wealth, grow it safely over time. We're not looking to score the highest returns possible. I'd rather take higher risk myself a little bit, maybe, if it was an investor capital. But for the investors, it's like, don't lose the money, and be a good fiduciary for them over a long period of time. And I've worked with my investors and then their children, sometimes grandchildren by now.
Yeah, so that's what motivates. That's in a way what motivates you too. I mean, I'm just thinking that's what that's the way how I feel. When you work with somebody, you're taking care of them. That's your expertise. You know what you're doing. You have the deal flow. You're giving them a safety, financial security to a certain degree that they couldn't get otherwise. So it's really
most financial advisors, they're sort of conflicted. They have to sell their own products, and that's why I always recommend, if our investors want financial advisors, go with like a registered investment advisor, RIA, that's more independent. And we have some RIAs that invest their clients' capital into our deals, for example, and they'll look at alternatives more. The most financial advisors don't invest in private placement kind of deals like real estate, like we're doing and stuff. So I'd say real estate should be part of anyone's portfolio that has significant net worth and is trying to preserve wealth. And
well, that's what I was going to ask you. Do you think that, I mean, I think I know the answer, but do you think that dentists, doctors that don't know real estate should be in real estate that have a certain net worth?
I mean, they're welcome to always do their own deals and stuff, but I always tell our investors, you're going to make the most capital money doing your own thing, being your own boss, running your own business, and then let us be your outsourced real estate arm. But because if you're a dentist and you start trying to buy your own buildings and develop, I mean, it takes a lot of time away from your core business, which is your dental practice or your whatever you're doing, right? So I always tell our investors, look at us as your outsourced real estate arm for your family, and we have around 1,000 individuals now that are all accredited investors. So they have all kinds of net worths from lower to way high. And as long as someone's accredited, meaning they earn, I think, over $250,000 a year or have a net worth of $1 million or more, excluding their personal residence, then they're welcome to invest with us. And there's a lot of people out there that have those qualifications and they just don't know where to start with real estate. And look, to dip your toe in, you could always buy REIT stock. There's publicly traded REITs, there's private REITs, but to own direct real estate, which has all the tax benefits, and you got to have a lot of money generally to buy a building. In LA, if you want to buy call it a 10-unit building, a small little apartment building, it depends what part of LA, but that could cost anywhere from $3 to $5 million, and you got to put $1 to $2 million down. That's a significant amount of capital. But if you put $250,000 into 4 to 8 of our deals and spread it into multiple deals, you're not gonna have any management. You don't have to do anything. Just literally sign the paperwork, send us the funds, and we do all the work on these properties. We source the deals, we oversee them, eventual disposition, exchange, and it's pretty minimal in terms of fees. And then and then they're giving up a piece of the upside. and that's how we get paid, and it's a win-win. If the investors do well, we do well, and our goal is just to help our investors invest in real estate.
I love the term win-win, because that's really what business, I think, is about, because, if you're making a lot of money for an investor and you're sharing in the profits, I think that is a win-win, because you got to get paid for your work, for your deal. If you're bringing value to the table, that makes sense. Which makes, one thing I get your emails on the Relief Foundation, the Resident Relief Foundation.
Yeah.
What made you start that? Because I thought that was really cool that you did that.
Yeah.
To help people.
Yeah, so we give a lot to a lot of different charities, but nothing was directly in our industry. And essentially, we wouldn't have a business if we didn't have, renters. And a lot of renters are responsible renters, and they've paid their rent historically on time, and they've been, good renters, but have fallen on, some kind of financial hardship. So we started seeing that happening in a lot of our properties, and we're like, if it's happening in our properties, it's happening in other people's properties. So how do we combat that? So we created the Resident Relief Foundation. We have a great board of directors. We're growing it actively. And what we do is we step in and provide rental assistance, a one-time rental assistance for people that are at risk of being evicted due to a financial crisis. And we've helped hundreds of people now. The average grant, last time I checked, was like 1.6 months worth of rent. So some are not even a full month rent. It's like partial rent up to maybe 4 or 5 months of rent. And generally everyone gets back on their feet. They have a job loss or a medical emergency or a gap in, unemployment benefit payment. Like, there's all different stories, and we've helped tons of people nationwide. We work with a lot of large property management firms that help identify residents of theirs that maybe won't qualify for like certain aid, but we're there to help them, and it's a win-win, because the landlord gets to keep a resident, not have to spend money on eviction costs and downtime on the unit and turn costs for the unit. So it's a big win for them, big win for the resident. Obviously, they don't have to have an eviction on their record, which makes it very hard to find housing, because that's like the first thing people check for as a landlord. And it's, homelessness prevention. There is around a third of our residents that we've helped have had no other places to go, and we're going to be on the streets or living out of their car or whatnot. So I think housing stability is like first and foremost for people. And if they have that, then it's easier to not go down a bad place, with, drug usage and homelessness.
Right.
And so that's why we started Resident Relief, and we're trying to just make it a big thing, just like everything we do, we try to make it big. So we're recruiting, people that are actively trying to help grow it and raise capital and make it people more aware of it. And it's a lot of money spent on, helping like people once they're on the street. But our thing is like, let's help them stay off the street.
Yeah. That's interesting. I saw that. I thought that was really cool, because you don't see that many landlords thinking that way.
Yeah.
But a lot of people have been in trouble, and they justifiably do need something, to keep them afloat. And if you have the power to do it, I think that's great. I believe there was a time where you were looking into self-storage and industrial properties, or alternative, not just apartment buildings. Are you still doing that? Or
we bought. Starting maybe 4 years ago, we bought 7 mobile home parks and 1 RV park. We've subsequently divested of all of those. We bought 9 self-storage facilities, and we currently own all those, and we're actively buying more. The mobile home parks did great for the investors for the most part, but it was tough to scale. They were smaller in size. It's good for mom and pop kind of operation. Or if you're in the management business. None of them, most of these mobile home parks are professionally managed in-house, and there's no good third parties really to hire, like in property, apartments. So we were stuck managing these. We weren't the best managers. We usually outsource and hire third-party property management companies for everything. And they were, sort of out in the parts of the world that we weren't actively investing in, like in the Northeast and Southeast. And so they were more spread out, and the investors did great, but it was just more of a not for our business model. It didn't work.
Okay. Speaking of location, I believe you stick to, Salt Lake City. I saw you buy some stuff there in Colorado.
Mm-hmm.
I saw you have a new deal in Long Beach.
Yeah.
That you're currently raising money for, I think. I don't know. It looks like a beautiful brick building. I think you usually stick to like 60s to 80s build or 70s.
Historically, but we're actively trying to sell a lot of the older buildings and exchange it to newer. And that's because a lot of these older buildings start really falling apart quickly as they age, and they were already old to begin with, and a lot of the major systems start failing. They cost a lot of money to keep up, and so that's sort of been a strategy, especially since the cap rates are close, like this between a 60s, 70s built versus a 90s or 2000 built. Yeah. They're all pretty low right now, so I'd rather buy something a little newer and be able to hold it longer than an older building.
So what do you look for in city location wise? Like, why do you go to the places you go?
Yeah, we were in Bakersfield first because of the oil and agriculture. We felt those industries would add a lot of jobs coming out of the 2009 recession. And then we moved into Phoenix in 2010 because there was blood in the street, and, prices went down like tremendously. But Phoenix is the 5th largest city in the United States, and we felt like eventually people would move back there and things would turn better. Which it did. It took a few years, but it eventually, and now Phoenix is leading the nation in terms of rent growth. And then we moved into Denver and Salt Lake City for different reasons. Denver, we saw a lot of like millennials moving in and huge population growth, young people, a lot of job growth. So we started buying there 5-6 years ago. Salt Lake City, we liked the story there, very pro-business. You had some geographic barriers to entry. You had a very educated workforce. It was the youngest state in the nation. And we started buying there 5-6 years ago. Reno, we got lucky with pre-Tesla. We bought in Reno. That market's been booming. We bought in Seattle, Portland. We look for stories, cities that we feel have longevity and, a lot of people moving to job growth, population growth. And, it seems like most of our building has been in Southern California, where there's more higher barriers to entry. It's actually, we feel like we could generate better yield building versus buying existing here in our backyard. We have bought some, but mostly new construction here locally. But I like to geographically diversify. I don't want to own just in one area in case, the big earthquake comes or any other natural disaster or some major industry gets transformed and dies out, or major employer leaves, or there's a lot of different reasons to diversify geographically for our investors.
Yeah. No, it's interesting. I'm going to Utah this weekend. I'm excited to see the city. I've only driven through the 70 and the 15, so
it's booming.
That's what I hear. I hear it's absolutely beautiful there. We go for the deal. If there's a good apartment deal, we go for that. I mean, it just depends what deals we come across. This one was just a land deal. My dad wanted to build his office. He called it the Ugly Duckling. So because it wasn't to make money, it was just a good location. He thought it wouldn't be bad. So, but it turned out to be a great opportunity. But usually commercial. The Air One, the Fidelity here on 12th and Wilshire. We have 300 acres in Hawaii, 330 that we've subdivided, entitled, and we've sold those during COVID. That's been really good.
Okay.
And then we have the Texas property.
Yeah.
That property. I love that property.
You've owned it a long time and you're looking to develop it, right? Or something?
I'd like to develop it, but that's prime for development. They've just put so much money into that block that it makes
What are
sense.
Apartments? Are those mainly local?
We bought 3 apartments in Beverly Hills.
Okay.
And when they passed rent control, and they didn't want to do properties with rent control.
It's tough. What size properties are these?
2 were triplexes. Another one was like a 6 or 7 unit. And we did really well with those. I think the IRR was 23% on one of them. I mean, they did well, but yeah, I mean, once you fix them, there was not a lot of upside after that. And we 1031 into a property that I'm doing in Carmel by the Sea.
So it sounds like you're buying in like A+ kind of areas.
It's usually A, yeah.
Yeah, it's interesting. But deals in those areas, something you could add value to. You see opportunity there and stuff.
Yeah, and it's safe. I mean, it's a different. Yeah. It's a little bit slower. I think it's also just a opportunity. My dad started the company, and maybe because he was an immigrant, he just wanted to protect more than anything else, and he was looking for deals in good locations.
What was the first one that he bought?
Ooh, that's a good question.
Or one of the first ones?
One of the first ones on Beverly Glen. It was an apartment building.
Okay.
It operated as an apartment building, but it had a condo map on it. So they were individual units.
Yeah.
It's similar to what you do because it was an older building. It had the unit sizes were like 2,200 square feet for 2 bedrooms. So like, he was getting market rent for a 2-bedroom, but not for a extra large 2-bedroom. So he raised rents pretty much right after he got it, and then he sold it to somebody who ended up selling it as individual condos.
Like a condo converter kind of thing.
Yeah. So
interesting.
So it turned out to be good. And in apartments was what he's developed a few on 3rd and Doheny. There's 4 that he developed there.
What size are those projects?
They were probably like 75 unit type of buildings.
Oh, big.
They were bigger, yeah.
Do you guys have them still, or?
No, we sold them.
Ah.
Yeah. We sold them. I think the Japanese were paying a lot of money in the
90s
early, in the early 90s.
Yeah. Time and inflation, those would be worth a lot.
Oh
of money
yeah,
today.
yeah, for sure. See, that's another thing. How do you get your deals? Because it's hard to find big deals like that, and there's not a lot of brokers, and
Yeah,
you got to sort of be in the.
It's properties of size. There's limited amount of brokers, which is good and bad. So like, it's good because there's a limited amount. You could really build relationships. It's all about the relationships. So you build relationships with the brokers and other owners. There's not that many owners that own these 200 unit and up apartment communities like the ones we're buying. So pretty tight knit kind of industry. It's so you could develop relationships, and it's all about your reputation. If they like you want to do business with you, maybe you'll get the last look to be able to stick in the offer if you want to take it or not. Maybe you're not even the highest offer, but you have a good reputation of closing. You come in with strong hard money. You're sometimes picked as number 2 or even number 3 bidder. So it's like all about relationships and reputation for these larger kind of deals. The smaller stuff is more like needles in the haystack. You have a broker doesn't understand the value of the thing, or it's mismarketed, or
right.
That's a different animal. But you generally, if someone owns a 200 unit asset, $50 million deal, they're going to list it with a top broker in the area, right. And each market has a small handful for the most part.
Okay. Is every city, it seems like there's a different number of property owners in every city. Like LA seems to be very diversified, where there's a lot of owners and a lot of properties. San Diego seems to be like 4 owners, a bunch of properties type of thing.
Yeah, I think it depends like the size of the buildings. Yeah, LA in general has a lot of smaller apartment buildings, tons of, families that have owned these a long time kind of thing. Other markets like a Phoenix that we started in have these much bigger apartment communities that are newer and bigger, and there's not as many owners that own these larger apartment communities. Even in LA, it's pretty cost prohibitive for a family to buy a 200 unit building in LA. I mean that alone is going to be $50-60 million plus. So yeah, there's families that do it, but you don't have as many obviously as the people that own 1 to 10 unit buildings, I'd say.
What would you say to somebody that wanted to start buying that? I mean, being in LA, it's hard to just imagine buying, because the triplex that I was telling you about, the cheapest triplex was $2 million.
Yeah.
So what would you say to somebody that wanted to start investing? Because the barriers to entry seem extremely high.
Start, in an area that's close to home. It makes it easier, that you think is just improving, and come find a story on a building, mismanaged, the out of town owner, the rents below market, and you got to start somewhere. Start in your backyard. Start small. A triplex in Beverly Hills is going to cost $2 million, but a triplex in the North Valley is going to be a lot less, right? So start. You don't have to start those high end kind of areas and stuff. There's money to be made in all areas.
Okay. What do you have any war stories or anything that really made you evolve a lot more than? I mean, experience is obviously invaluable, but
yeah, I think more. I'm sad we sold a lot of buildings, kind of thing. Like, I heard an expression like, one guy's like, "You sell, you lose." Essentially, you never want to sell. And yeah, all these buildings we bought in Phoenix for 50,000 unit, 40,000 unit, 60,000 unit, or 150 to 200,000 unit. We sold them all 3-4 years ago, and it's like they've gone up like bonkers since then. So I'd say, that those are the biggest costless mistakes, are the ones where we've sold, and We sold though to create a track record, return capital to investors. In the early days, we didn't even exchange. We sent back the money so they could feel it, touch it, see it. And now, the last few years, we're able to consistently find properties to exchange into. We do it that way. But we built a track record. We put a few bucks in our pocket because that was, as an early syndicator, we were making decent, okay money, but we needed to have a few bucks in savings, and we made it on the back end when you go sell a building. But nowadays we could hold longer term because we have significant cash flow splits with the investors, and long term we wanted to be aligned with them to hold long term and eventually just keep refinancing and pulling out money. And it's a long term game, especially for the syndicator or sponsor.
Long-term game. There was something that I heard somewhere in a podcast. I listened to a few of the ones that you've done because it's fun to listen to you, and you have a lot of energy and you have a lot going on that, to hear you speak. You said there was a point in your career where you hired at somebody or you partnered with somebody that was going to be your fundraising counterpart. I think it was an older guy.
Fundraising. We have a lot of people at the company that are active in, our, my dad, for example, he's an attorney, but he's always, helping us raise capital. And we have another gentleman who goes back and forth from China, and we have a lot of mainland Chinese investors that we've raised capital from. And other people on our team also help raise money just from their networks. And even though that's not their primary job, it's sort of as a syndication business, that's the lifeblood of our business, being able to raise capital for these deals, because we're not, we don't have any one large institution that could just write the check. We're clubbing it together. We're clubbing a lot of money together, 20, 30 million for some of these larger deals that we're buying of equity, but definitely still having a lot of individuals come into the deal. So it definitely I take a lot of my time just meeting with people and introducing them to what we're doing and building those relationships, and sort of outsource all the other things to people that are better than me now at dealing with construction management and asset management and accounting, and we have 20 people in the company that do all these things.
That makes sense. I mean, you have, I think, over 700 investors. I mean, that's a lot of bookkeeping.
We have 5 people in accounting. That's the biggest department. We have almost 1,000 investors now, and
wow,
a lot of projects around 5,700 apartment units and 9 self-storage facilities, and it's definitely a growing portfolio for sure.
So the last 3 questions I always like to ask, just what are 3 daily habits that you do, that you have?
Daily habits, I'd say every morning, kiss my children, say good morning to them, kiss my wife before to go to bed and in the morning. I'd say I'm always on Twitter in the first thing in the morning to understand what the news is for the day in stuff I like, tech, real estate. And then another habit, I'd say I try to work out every day. It doesn't happen though, so it's usually like 3 days a week kind of thing. Do some kind of exercise. I like to run. I like to do the Peloton. Starting to do some more workout, sort of strength training and stuff. Other habits, I'd say. I go through I have like a checklist, a to-do list kind of thing where, I put the biggest things at the top and don't let them creep down to the bottom. Like try to take care of the stuff you want to let slide. You got to take care of, kind of thing. Yeah. And just keep pushing forward and making meetings, meeting potential investors, meeting other owners of apartments. Make sure keep the calendar full with things that get us towards our goal of just helping our investors build wealth. And if they do, then we do in the process,
Yeah, keeping your eye on the ball.
Yeah, exactly.
Because there's a lot, I don't know, I mean, there's so much to focus on. Social media, I don't know.
Yeah, it's easy to get distracted, which I've fallen to, and everyone does. But
I'm highly, that's hardest lesson. It is. There's a lot of balls to juggle. It's nice to have people to go to. I mean, I was going to ask you about your assistant, Natasha. Like when you decided to get her, it probably made your life so much easier.
Yeah, I mean, we should have done this years ago to have she's like an executive assistant / personal assistant, and it makes her life a lot easier. And I always say I want to free up my time to be able to do stuff that materially helps the company, which is, fundraising and marketing and investor relations and like strategic vision, and let other people do stuff that'll take away time from me, where I move the needle most. And I think having, and my calendar has just gotten busier and busier over the years as we've continued to grow. So it's nice to have someone manage the calendar, and she manages all the email blasts and all the travel for all the executives and personal stuff for, family. And it's nice to have someone like that. Definitely worth its weight in gold. Yeah.
What would you say to people, the last question, what would you say to individuals that want to get started to have some real estate or invest in real estate?
Yeah, I'd say, identify good people that have long track records of, doing well for their investors. Ask them the hard-hitting questions, ask them about their worst deal, not just their best deal. Ask for investor referrals, essentially partner with good like-minded long-term sponsors if you're going to invest with other groups, and invest in stuff you believe in. Like, I love apartment building, self-storage. That's what we're doing. But if you're interested in industrial, there's a handful of groups that I could recommend for that. Or if you're interested in hotel, whatever it is, invest with quality sponsors and for the long term, I'd say. And look, there's nothing wrong with owning your own real estate as well. It's just a different route, and it takes away maybe potentially your time from whatever your main business or career is. And that's where I always recommend people focus on, unless you want to make real estate your full-time career, which is awesome. But it definitely, and it could be, but it's generally just an investment for people.
Okay, well, thanks for coming on the show. It's a pleasure to have you.
Yeah,
Nice spending time with you.
Yeah, man.